insight that ties SMCI's earnings disappointment, management commentary, and hedge fund positioning together while framing the broader investor debate around the company and the stock. Supermicro's fiscal Q4 2025 earnings report triggered a sharp negative market reaction, with the stock tumbling more than 20% over 5 trading sessions as results came in shy of Wall Street's lofty expectations. The company reported $5.76 billion in net sales, missing consensus by about $156 million, while adjusted EPS also fell short. Guidance for the current quarter likewise underwhelmed, fueling concern that SMCI's explosive growth trajectory may be losing momentum. Management attributed the shortfall to 2 primary factors: capital constraints that limited the pace of production scaling, and delayed revenue recognition tied to a major customer's late-stage specification changes. CEO Charles Liang described these issues as temporary, stressing that demand for AI servers, data center hardware, and green computing solutions remains robust. He highlighted that the company's B300 and GB300 data center building block solutions, DCBBS, are designed to give customers faster time to market and time to online, positioning Supermicro as a critical enabler of AI infrastructure deployment. Still, Lang acknowledged near-term headwinds, including customer purchasing cycle delays, evolving product mix, and competitive pressures that could weigh on margins and revenue growth. The company's guidance reflected both optimism about long-term demand and caution regarding the next few quarters. While Wall Street reacted negatively, some investors argue the sell-off is overdone. KM Capital, for example, urged holders to stay long and strong, contending that SMCI's AI-driven growth story remains firmly intact despite a softer quarter. Their thesis: the temporary bottlenecks are overshadowing a much larger structural trend. SMCI's role as a central player in powering the next wave of AI and cloud computing buildouts. Adding to the complexity, hedge fund activity has further influenced sentiment. On August 15th, Philippe Lafont's Coatue management disclosed in its Q2 13F filing that it completely exited its SMCI position alongside Monolithic Power. Instead, Coatue rotated heavily into Oracle with an $843 million position and ARM with a $749 million position, while also boosting exposure to CoreWeave, Broadcom, and NVIDIA, a clear strategic tilt towards large-cap AI infrastructure and cloud players. The moves reflect a recalibration by big funds, reinforcing conviction in hyperscaler-linked cloud and chip names while trimming or exiting more volatile mid-cap players like SMCI. Coatue's exit raised eyebrows, as the fund had been a high-profile SMCI backer, and its withdrawal may have amplified market jitters. For investors, the key debate now centers on whether SMCI's stumble is a temporary speed bump or an early sign of growth normalization. Bulls emphasize that AI server demand is still surging, SMCI's modular designs give it a strategic edge, and its customer pipeline remains strong. Bears argue that supply chain, capital, and competitive risks may cap upside, while large funds rotating out could signal more institutional skepticism. In short, Supermicro remains at the heart of the AI infrastructure boom, but the earnings miss, cautious guidance, and Coatue's exit have injected a new level of uncertainty. The next few quarters will be pivotal in proving whether management can execute through scaling challenges and reaffirm the company's position as a leader in AI data center solutions.
Okay, so SMCI still, let's see, this is its 4-hour chart. That's this the decline with earnings outcomes. It's just been distributing, it's just been on a distributive contraction. The extrapolation is saying that by Monday, we are expected to get a bounce, but there's no guarantee that that will be the case. In terms of projections, we have a couple of projections. 43.14, the stock is coming towards those sort of levels. And then above, we have 46.95, 48.52, 50.14, 53.35, 55.72, 62.06, 65.97, 69.82. selling pressure, what has happened? Yeah, okay. Everything is severely negative, apart from the 21 period moving average that is still in decent amount of that's still decently trending. Yeah, okay. Let's have a look at its daily chart. On the daily chart, a bounce is equally expected to remain in place to kick in by Monday the 18th, and then also remain in place up till Friday the 22nd. There's no guarantee that that will be the case. So all in all, the extrapolation on the daily chart is saying that it's going to have a neutral, just sideways movement up till Thursday the 11th, and then after that, Thursday the 11th of September, and then after that, there might be a resumption to the upside. Okay. So in terms of projections on this daily chart, we have the sort of projections we have already mentioned. $69. It's a risk. It's been reiterating the $69 since the 9th of June. You see that 9th of June. This is 60. Yeah, this is $69. This is 69. No, it's $58. 58.07. It's been reiterating it for how many sessions now? 9th of June. The whole of okay, that would be like almost the whole of June, July. I mean, this is 2 months now of reiterating 58.07. There must be something there. Anyway, we get that a lot. We get that a lot. You know, its next resistance will be 48.20 on this daily chart. Price pressure momentum must be amplified as well. Yeah, okay, not really amplified, but it's a lot more severe here on the daily chart as against what we have on the weekly on the 4 hour chart. So price pressure momentum one, that is 10-day moving average, is severely bearish, and 21-day moving average is equally bearish. But they both have positive second derivatives, indicating that maybe selling pressure maybe running out, maybe ending soon. Maybe that's why we have this bounce that is expected to kick in from Monday the 18th and remain strong up till Friday the 22nd. It's just saying that the rest of this coming week is expected to be strong. Let's see how things go. Fingers crossed. But it's also good for us to have a look at the price, the market grid. It's going to give us an indication of the sort of range that the stock can trade within. So I'm going to apply that now. Okay, so we're going to have a look at the grid down here. It's all contracted. So we have between 44.20 and 46.78, just a narrow range, if you like. So the algos are not expecting, as things stand right now, volatility has crashed. Has crashed. It's expecting that the stock is going to trade within a very tight range, but in a very short time. Yeah, let's just see how things go. Yeah. Okay, so there you go. That's the latest on SMCI. I'll continue to update you. Thank you very much for watching this video.